Hi there, welcome to Kneppy Invest. Our favorite ASX glove manufacturing company, Ansell, released a financial year 23 trading update and a financial year 24 guidance update on the 18th of July. Now, that financial year 24 guidance update is fairly unusual. Now, I wouldn't expect a company to release any sort of guidance for the next financial year or this financial year until at least the company releases their financial year 23 results. But the market didn't like this particular update from Ansell, and the share price dropped almost $4, which is 14%. So I'm going to have a look at why the share price might have dropped for Ansell today. Was it based off their financial year 23 trading update, or was it based off their financial year 24 guidance? Now, for those who don't know, and I've already mentioned that Ansell produces or manufactures gloves, and I've just gone to their website because I want to know if they produce anything other than gloves. So these are their products. So industrial hand and arm protection, mostly gloves, but they also produce sleeves, body protection, so it looks like full body rubber sort of stuff, surgical gloves, exam gloves, specialty gloves, safety devices, in life sciences, gloves, protective clothing, goggles, rubs and isolator gloves, face masks and accessories. So you notice here they don't sell any more condoms. And there was a website, there was Stocklight, who actually mentioned that the condom manufacturing company Ansell had a profit downgrade or something today. That's not right. I believe, I could be mistaken here, they've sold out, or they sold that condom manufacturing part of their business quite a few years ago. So that is what Ansell does right now. Now let's have a look at this particular announcement. Was it the financial year 23 update, trading update, or the financial year 24 guidance that spooked the market? I'll just increase the size of this particular document. So the first half of the announcement is the trading update, and the second half is market conditions and the business trends. So the first thing in the trading update is their results or expected results. So they have mentioned a statutory financial year 23 EPS is going to be in the range between $1.17 and $1.18 US cents or dollars. Now, this is within the range of guidance they gave at the half year results. So they do mention here at the low end of the original financial year 23 guidance provided at the financial year 22 full year results on the 23rd of August. So they have hit guidance, their own guidance. So I don't think exactly decrease in share price can be attributable to their trading update. So let's have a look at their financial year 24 guidance, and they have given us some guidance. So just remember their financial year 23 earnings per share was 117 to 118 cents US cents. So this is a guidance for financial year 24. It's somewhere here. I know it's somewhere here because I read it earlier. Here it is. Here's the financial year 24 guidance all the way down to the below. So remember, 117 to 118 is for financial year 23. And they expect financial year 24, this is adjusted earnings per share, to be in the range between 92 and 112 cents. Statutory earnings per share is to be in the range between 57 and 77 cents. So more than likely, this is what spooked the market, just their financial year 24 guidance. And they have made some key financial year 24 assumptions, and some of these assumptions may not come to fruition. In fact, their results could be better than expected or worse than expected. For instance, without the benefit of the hedge book gain in financial year 23, foreign exchange rate to reduce EBIT by $9 million, normalization of incentive costs to reduce EBIT by $39 million versus financial year 23, books tax rate to be in the range of 22.5 to 24.5, interest costs to increase to $29 million on increased gross debt, and capital expenditure to be in the range of $60 to $80 million. So main reason why the share price has dropped a lot for this company is because of the financial year 24 guidance. Now, I could be wrong, and I'm not a spokesperson for the whole market, and maybe the market just didn't like that they hit this year's guidance, but I believe it's just the 24 guidance was not above this year's results. So that's really all I have to say about, actually, no, I'm going to keep going. So is this an opportunity to buy Ansell? So let's have a look at the chart first. So let's have a look at the weekly chart. Now, I would call Ansell a borderline high quality company. The main reason I would call Ansell a borderline high quality company is if you look at the weekly chart. In fact, let's have a look at the monthly chart to get a better indication of what this company has done over the past 20 years, 22 years. So the share price has gone up over the last 2 years. So share price has been in a long-term uptrend. In fact, the share price has increased from $4 to a high of $44, which was in 2021. At times, there has been dips in the share price. We saw that dip in 2015-16. And we have seen that dip in recent years because this company was a beneficiary of COVID-19. Don't forget that. And those tailwinds have come to an end. Now they're facing a little bit more headwinds. And I think the market might have been expecting those headwinds have come to a complete end and earnings per share would increase in financial year 24. So let's have a look at the daily chart just to see if the share price is in any sort of uptrend. No real reason to get excited about Ansell just by looking at the daily chart. Share price really going sideways. Looks like the next really good support level is around about $21. So share price still well above that. And the reason I'm saying that's a support level is because the share price of Ansell in June of last year hit right above $21. Now let's have a look at the hourly chart, which is what I'm looking at a lot now. And this is interesting. So I did put Ansell onto my watch list because it did look like Ansell was trying to get into a 1 hour uptrend. So potentially the market was expecting if the company released a trading update, it would be a positive trading update. So this did disappoint the market, and you might be able to argue with me that the market got this wrong. So luckily, I did not take a position in Ansell based off the hourly chart, and that would have been a fairly big loss. That would have been an automatic sell today if I did see that and I was a shareholder. Now, I've already mentioned that I would consider this a borderline high quality just because of the chart. So over the last 20 years, the share price has been in an uptrend. So let's have a look at some of their financial numbers over the past 15 years. So the main thing I'm looking for here is revenue growth. So 10-year revenue growth is 8%, 5-year 12.8%, 1 year negative 7.7%, and the last 3 years is at 11.4%. So what I'm looking for here is revenue growth above 10% per year. But the main reason why I would not describe Ansell as a high quality company is their return on invested capital. Now, their return on equity, and this is Guru focused, by the way, 15 years of history here, but I am a subscriber. The return on equity typically is above 10. Only a couple of years in the last 15 has their return on equity been less than 10. In fact, right now it's at 9.5, so the lower end of the range. But if you do look at return on invested capital, typically over the past 10 years, it has been less than 10. And I tip most times I want to see return on invested capital greater than 10. So this is one of the reasons why I would not necessarily call this company a high quality company, a borderline high quality company. If they can get return on invested capital above 10, consistently above 10, I probably would class this company as high quality. Nice. I was looking at margins there. So gross margins around 36%, net margins about 8.2%. And that's okay because this is a manufacturing company. In fact, in Guru Focus, if you just open up the net margins, and it will take you to a competitive comparison. It'll try to compare Ansell to other companies, but it's comparing Ansell to Nanosonics, Trajan Group, SDI, Osco Healthcare, ITL Health, Medical Australia, and net margins. Yeah, Ansell has better net margins than most of the companies, apart from IT Health, which I don't know anything about. Anyway, so is this a potential buy? Is this the worst it's going to get for Ansell? What I would do, because I don't consider this a high quality company, is I just trade this company. And what I'll be looking for now is a bottom to be reached in the share price and then an uptrend in the share price. Up until then, I'll just keep this on my watch list, looking for signs of a turnaround in the share price. So if you have any questions about Ansell, if you have any thoughts about this particular trading update, if you disagree with me, if you think the share price decreased by 14% because of other reasons other than the financial year 24 guidance, I'd love to hear your thoughts. Maybe I am completely wrong. So leave your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.